let's talk about interest-bearing notes. Before we can talk about interest-bearing notes, we have to talk about the notes receivable itself. What are notes receivable? Notes receivable are rights to receive a specified amount of cash, either on demand or at a certain future date. What is a note? A note is a negotiable instrument signed by maker and received by payee. If you make a note and put my name on there, you're going to pay me at a certain sum of amount in the future, then you are the maker, I am the payee. Interest-bearing notes is the one has a stated rate on the face of the note. Of course, you have another kind called non-interest-bearing notes. That is, the note does not carry a interest amount on the face. Now we're here to talk about interest-bearing notes only. Let's talk about reasons for accepting a note. One of the primary reasons to accept a note is to help your customers or clients out. Let's say this client has been paying you good in the past, but all of a sudden run into some kind of financial difficulty. So your client or customer asks you if you would extend him credit term. You say you would. That means you convert the accounts receivable to a note receivable. Let's say this note receivable is either 6 months or a year, 180 days or 360 days. Upon the due date, the client agreed to pay you that certain amount of money. Now the second reason is to sell products or services to high risk or new customers. Often you would sell products or services to a new customer, but you don't know how this customer is going to work out. Therefore, you agree to start out with a note. If it proves that the customer is a good customer, pay you on time, and then you can start giving the client or customer an open account. We call that accounts receivable. Third reason is you would make a loan to your employees or your subsidiaries, and you want them to sign a note. The fourth reason is you may sell property, plant, and equipment, and your customers or your clients or buyer do not have enough cash to pay you the whole thing, so they might pay you partial cash and partial in the note form. The last reason, which is almost the most common reason to have a note, is you as a lender, you would loan money to borrowers. You buy your house with a note, and you buy your commercial building with a note, or you buy a car with a note. Before we can go in and talk about interest-bearing receivable, note receivables, we have to understand present value. Now you see on the screen, on the bottom I have a present value of $1. On the top I have a present value of an ordinary annuity of $1. Let's look at the present value of $1 first. You see my blue arrow just pointed to 91 cents under the 10% interest rate. That means a year later, $1 does not worth $1 today. Today's value is the present value. On the same token, the 83 cents today, someone gave you $1 2 years later. That same dollar only worth 83 cents today. $1 3 years later only worth 75 cents today. $1 4 years away would only worth 68 cents today. Now let's look at an ordinary annuity of $1. What is an ordinary annuity? Before I can explain to you on ordinary annuity, I must tell you what annuity is. An annuity is a series of equal cash flows occurring at equal intervals over a period of time. Let's say someone agreed to pay you $100 every month end for a year, then that's an annuity. An ordinary annuity is an equal end of period cash flows occurring at equal intervals over a period of time. Let me emphasize that end of period cash flows. In other words, you do not pay that amount at the beginning of the period, you pay that amount at the end of the period. If you pay the amount at the beginning of a period, we call that annuity due. With that being said, now let's look at the 3.17 on our screen, where my blue arrow points at. What is the 3.17? Earlier we talked about 83 cents is that the same dollar 2 years later worth today. And then 75 cents is that same dollar 3 years later worth today. Now 68 cents is the worth of that dollar 4 years away, converted back to today. So you add them all up, you will see 3.17. You see on my left hand lower corner, it shows that 3.17. How do we apply this concept to what we're going to do here? Now let's look at it. On my screen, you have a top section, you have a $3,170. That is to convert that $1,000 at each year end for 4 years back to today's value. Therefore, you use $1,000 times 3.16986 conversion rate, and then you have $3,170. That is to convert the future $1,000 at each year end for 4 years back to today's present value. You have $3,170. What about that $10,000 present value? That is a one-time deal. It's not an ordinary annuity. In other words, 4 years later, you will either give or pay $10,000. How much does that $10,000 worth today? So you are using the table below. Use $10,000 multiplied by 4th year conversion rate, that is 0.68301. Therefore, you have $6,830. Let's look at our example here. January 1, 2012. Good Neighbor Corporation makes a loan to needy company and receives in exchange a 4-year $10,000 note. The note carries a interest rate on the face. It says 10% annually. And at that time, the market rate was 12%. How does this Good Neighbor company record the receipt of the note? Pay attention here. You will see my red arrow is pointing at 12% of the interest rate. We are not using the 10% interest rate. That earlier present value table I showed you is using 10% interest rate. That is just to explain to you the concept of present value. Once you understand that 10%, now you can come over and understand the 12% interest rate. Why do we use 12% interest rate? Because we are trying to convert that $10,000 one-time cash flow back to today's value. We are also trying to convert that $1,000 for 4 times at each year end back to today's value. Therefore, when you convert the $10,000, you would use that conversion rate of 0.63552. It's a present value of $1. So you will get $6,355. Let's look at the present value at the top. You're converting 4 of the $1,000 interest you're going to receive at each year end for 4 years. That it tells you it's an ordinary annuity, and that conversion rate is 3.03735. So you will have $3,037. You add those two together, you will have $9,392. Now let's look at how this presentation table looks like. First, you will see this $9,392. That is the carrying amount that we're talking about on the last slide. I point to you in red $1,000 cash received. Why do we only receive $1,000? Because your note receivable says the note maker is going to pay you $1,000 a year. That is 10% for the $10,000 they owe you. So $10,000 multiplied by 10% is $1,000. You see where I pointed at 10%? So we have that first $1,000. Let me show you the interest revenue. The third column, the middle column on my table here. Remember, this is the most important part of the concept here. The interest revenue actually is the amount you are entitled of. The note only says 10%. That's what you and the note maker agreed. But in reality, investors in the market are willing to pay 12%. So that's what you actually are entitled of. Therefore, your true interest revenue is $1,127. How do we calculate that? Look at where my arrow is pointing. You use that $9,392. That is your carrying amount of the note. Actually, that is the amount you receive the note and you willing to sacrifice, give to your note maker. You're not giving him $10,000. You're only giving him $9,392. You always use the carrying amount multiplied by your market interest rate to calculate the interest revenue. That's most important concept. Interest received is calculated by using the stated rate, but interest revenue is calculated by using the market rate. So you see $9,392 multiplied by 12% market rate. Therefore, you are getting $1,127 revenue, not receipt, but revenue. Now let's look at the next item. You show the 12%. That is the interest revenue. Now 12% multiplied $9,392, you have that $1,127. Let me show you how you get that $9,519. Look at the right hand, the last column on my table. Note the carrying amount start out $9,392. It gradually goes up by the amount of your discount. What is the discount amount? The discount amount on the notes receivable is actually your unearned interest. In other words, you look at the $1,000 interest received compared to the $1,127, the amount you actually deserve. You are short of $127, and that is the amount you did not give to your borrower at the first place. Therefore, you are recognizing that part as your interest revenue. That's why we call it discount. So first $9,392 plus that first $127, you will have $9,519. And then that $9,519 at the second year end, add to that new amortization amount, $142. You will have $9,661. So 4 years later, your carrying amount is that $10,000 you will collect back from your borrower. But you did not give that $10,000 out from first place. You only gave $9,392.